Today's guest is Shamin Walsh, Managing Director at BAM Ventures, one of LA's most active early-stage consumer funds, and one of the earliest backers of breakout brands like Honey, Pretty Litter, and Merit Beauty. BAM was founded by serial entrepreneur Brian Lee, who was also co-founder at LegalZoom, Shoe Dazzle, and The Honest Company, and has spent the past decade backing consumer founders who deeply understand behavior, distribution, and community. In this episode, Shamin and I dive into how the founder-investor dynamic has changed with 1,000-plus funds now chasing fewer breakout brands, why the best founders don't just make great products, they understand consumer psychology, how brands like Merit and Pretty Litter built cult followings by solving problems that aren't always functional, what fundraising looks like in 2025-2026 for consumer brands raising at the pre-seed and seed stage, and why the next wave of consumer innovation might come from distribution, not product. Shamin also shares her take on GLP-1's ripple effect on fashion and lifestyle, the return of nostalgia-driven trends, and why founders should always build in buffers for cash, timing, and mental health. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, and acquirers to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Shamin, awesome to have you on. You've been investing in consumer and consumer brands since the earliest days of D2C 2.0. Being at BAM for nearly a decade, you were doing angel investing before that. We're talking about that kind of pre-recording. What's maybe changed the most in founder-investor dynamics since those early years?
Yeah, well, first off, thank you for having me. And I'll give you a quick one-liner for anyone who's not familiar with BAM, just to help contextualize the conversation. But we're a pre-seed and seed consumer-focused fund based in LA. My partner, Brian, and I are the two managing directors, and Brian has been a very successful serial entrepreneur, having taken companies like Honest Company and LegalZoom public, and currently CEO of Arena Club. So we love consumer, we love early stage consumer, and so it's really relevant to be on this podcast. To your question, I think what's changed is the expectations of founders from their investors, because when I started investing in a professional venture fund in 2014, there was something like 300 venture funds out there. And now there's probably more than 6,000 according to PitchBook data. And so, really great founders have choices, and it's not just capital. There's an element of, how valuable or strategic you are, how likable you may be, how easy you are to work with. And so I think that the bar is higher for investors to really deliver for founders, given how many investors are focused on, a small subset of probably the greatest founders.
It totally makes sense. And when you think about BAM's best performing brands, those few that you mentioned each year that are going to be the breakouts, what do they have in common?
I'd say that the brands that share similarities in terms of excelling is truly understanding that products don't sell themselves, and truly have an understanding of consumer psychology and behavior. So, for example, Honey was one of our biggest and earliest successes. And part of what was so great about that platform is they understood that it was a very frictionless experience for the consumer. You didn't have to necessarily log into anything. Anytime you wanted a discount, it would pop up passively. It was hard not to be engaged with something where at the point of checkout, something pops up and says, would you like to save, X amount? And it doesn't cost you anything, and you don't really have to do anything. Other founders like, Daniel from Pretty Litter, for example, understood that, that was an incredible business model, because people who have cats love their cats. The whole adage about being crazy cat people. People who have cats usually have more than one cat. Kitty litter is heavy, so it's a very natural product that you'd want to subscribe to and you'd want shipped to you. It's not something you'd necessarily want to carry home from the grocery store. There's habitual behavior behind it. cats are notoriously stoic creatures. And so having a product offering where it's diagnostic and you can understand more about the health of your cat. So I think, understanding that consumers, in both examples, are very different products. One is consumer tech, one is a kitty litter. But, both of them understood that they were solving a problem in someone's life, and not necessarily ask asking that much of them to get to the benefit of the product.
Yeah, the problem solution in CPG is a really interesting one to review because I think like most startup 101 classes, that's like the first slide, focus on a problem, find a solution. But that hasn't always been the case in CPG or D2C. Sometimes it's just like, hey, we're going to put a new spin, a reposition of something that has existed for a long time. And so I guess like how much of BAM today do you focus on like, hey, this really needs to be solving a problem and it needs to be doing it seamlessly? Or can it be a like, hey, this is just cool and on trend and it's got, distribution either through a retail partnership or a celebrity?
Yeah. I mean, that's a good distinction. I think in some way it is still solving a problem in the sense that perhaps you're not solving a functional problem where whatever the thing is that you're purchasing could not be found in some other iteration, but you are solving the problem and that you're speaking to somebody or in a way that has not resonated with them before. So, for example, Catherine Power has started, we're investors in Merit Beauty. She is not the first person in the world who has started a cosmetics brand or a blush brand. She hasn't solved the problem in the sense that, wow, I had nothing to put on my face before and now I do. But she has solved the problem in that she's cleared up mental bandwidth for her consumer because, I would be her stereotypical consumer. I'm a busy person. I want to look elevated and chic, but I have a full-time job. I don't have time to, do a 12-step contour process. And so she created a brand, 5-minute beauty. It's like, you want to look good, you want to look put together, you want to look professional. You have 5 minutes. Here are the essentials, and this is what, you need to do. And so I think, of course, brand plays into it, but I guess that what I'd argue is that even when something is just branding and marketing, it may, if they're doing a good job, they're solving a problem in the sense that they're speaking to someone who has not resonated with whatever has come before, even if that product has existed before.
Yeah, it totally makes sense. If you think selling to your domestic market is good, wait till you see what happens when you truly go global. That's where Passport comes in. Passport is a full-stack global commerce partner built for ambitious brands that want real international scale without the headaches. They can help you launch and ship in-country in key markets such as Canada, UK, EU, and Australia. Or they can help you ship cross-border. With Passport, you get smooth international shipping to over 180 markets, fast, DDP-ready, with branded tracking, high-touch customer support, and top-tier delivery success. Your compliance, taxes, duties, and customs handled end-to-end. No surprises at checkout or customs, just clean cross-border expansion. They'll even handle your duty drawback claims. And you get localization and storefront adaptation, local currencies, shipping rates, payment methods, and tailored checkout experiences so your brand feels local no matter where you ship. Passport works with most US and UK-based 3PLs and with top brands like Ridge, Hexclad, OneSkin, Dolls Kill, and many more that have already turned Passport into their growth engine for global sales. So if you're thinking global, if you want to scale into new markets, unlock demand outside your home country, and do it the right way, go check out passportglobal.com. Speaking of brand, so much of institutional capital into brands has gone straight to Meta or to paid acquisition. I think there's now maybe been a bit more rebalancing into kind of building brand marketing budgets or really trying to think through positioning and building brand equity. Is that something that you're seeing in market? Is that something that you're looking for? In terms of budgets being balanced, both budgets and bandwidth being balanced to, hey, we're just going to be purely optimizing the meta funnel and dialing each thing down the funnel to make sure that we're getting the right CAC and we're maybe less conscious of overall brand hierarchy, thus kind of traditional brand marketing of saying like, hey, we're going to be very thoughtful and spend energy and dollars behind really standing out in market, thus just meta arbitrage.
I think you need to have a balance of both. I think that paid acquisition and meta, so to speak, performance marketing is a very technical thing. It does take technical rigor to figure out what channel is working for you to have the most efficient awareness. But I think that that's not how you create brands that create emotional connections. And so there does need to be a level of, creating that point of view that people can resonate with. It's not just about, again, back to the example in the prior conversation around, that functionally many things already exist, right? But whether or not you resonate with it and you want to become a purchaser of it is different. And so I think that the brand marketing side of it is very important. I think that historically, people thought of brand marketing as expensive, glossy photo shoots and these like beautiful brand campaigns. And now, you see people have gotten really creative and with UGC, for example, or it can be very unfiltered or it can be very organic. It doesn't have to be a big budget buster. It could be, really getting in the field and having, starting in certain distribution channels where you become known for a certain super fan community. For example, I remember, a friend of mine from college had started Halo Top Ice Cream, and he had mentioned how you, in the very early days, you just didn't have that much budget, and it was really hard to do sampling in the Whole Foods freezer aisle because it was hard to stand out against all of the other ice creams. And what really took off for them, especially being, a high protein, low calorie ice cream, was to really go into the CrossFit gyms, and they like really integrated into these CrossFit communities. So I would consider that brand building and brand affiliation. And, you have this community that has now identified this as like a product of choice and created that affiliation. But I think you have to, and that doesn't cost a huge photo shoot or anything. It's just being in the right place. But I do think it's really important to juxtapose the performance marketing optimization from actual brand building, because that's what creates longevity.
Let's move to kind of fundraising and sequencing fundraising, when to raise, how much, how to think about it. Pre-seed and seed today, what are you looking for in terms of scale and progress?
At BAM, we are often the first institutional investors in the companies that we invest in. That may sometimes mean pre-launch, depending on the relationship that we have with the founders. I think for us, it can sometimes be challenging to invest pre-launch because we do so much of what we're evaluating is how well the founder understands consumers and consumer behavior. So we like to have some kind of a sense of what consumer behavior looks like. Typically, the companies that we're investing in the CPG or brand space are very early, like just launched probably a couple months ago, you know, 2, 3, 4, 5, 6 months ago. So it's still very early. Um, and it's less hard and fast numbers and more, again, understanding consumer behavior. So do you have or some kind of distribution advantage? So do you have an interesting distribution advantage or a channel or that's getting around this paid acquisition trap that we've kind of alluded to, or saying to the extent there is repeat usage, what kind of repeat usage looks like already, looking at how folks are resonating with the product, how folks are sharing the product. So it's less about, hey, we are looking for brands that are doing at least 30K a month revenue or some kind of black and white number, and more it's just showing signs of rising above the noise for the folks that they're trying to attract.
Are you still expecting your brands to be raising a median of 3 rounds over its life cycle, or are you saying, hey, let's try to be really capital efficient, especially at, maybe it's past this pre-seed and it's at the seed round. We're going to put a quantum of capital that may be able to take it to pretty meaningful scale. And then we can maybe toggle around profitability from there.
The benefit of our strategy is, given our entry point and given our fund size of 50 million, which has been very intentional, we are probably as close to the founder's journey and interests as they are that an investor can be. And so we don't have hard capital deployment figures where we really want to encourage founders to take in X amount because that's how much we need to deploy X amount, right? So, for example, Pretty Litter only raised $1.5 million and became very profitable and exited for, under $1 billion. So for us, being as capital efficient as possible is a great thing. It's pretty difficult for a lot of brands to only raise that amount, but as far as us having incentive to force a brand to raise more or have the signaling of certain amounts of fundraising, we don't have that.
Why do we love Numeral? Well, here's the good, the bad, the ugly. The good is that over 2,000 e-commerce store owners just like you use them for sales tax compliance, including brands like Graza, Ridge, Gruns, and 8 Sleep. The bad is that none of us got into this to spend a ton of time on sales tax and admin, which is why Numeral is able to help you in 5 minutes or less get full coverage, deal with registrations, ongoing filings, and compliance. It just all happens in the background. And the ugly is that not a lot of store owners know that sales tax is actually personally guaranteed. Said another way, that the states could end up coming after you personally if you're not on top of it. Even being a modest $5 million store owner, you could have Nexus in 20 to 30 states. Again, Numeral helps you stay compliant, and they even guarantee their work. That's why we love them. Go and check them out at numeralhq.com. And then, are there any changes in consumer behavior happening right now that you're excited about, that you're looking for, that you think will drive, the next wave of consumer breakouts?
I think consumer is a very cyclical category. So you see a trend of this urge for novelty. I think there's always this push-pull between novelty and nostalgia. And so I am seeing certain elements of nostalgia come up that I think are pretty interesting. I think that we were in a very strong athleisure, kind of soft fashion, so to speak, phase. And I do think I'm starting to see people get a little bit more glitzy and blingy again, which maybe ties into nostalgia. And I also think I have this thesis where I think we're going to see so many downstream effects tied to GLP-1 use. And I think one of it obviously has to do with folks seeing their bodies in new ways that they may not have before. And so they may be wearing things or showing more of their bodies or dressing up more. When you feel good about yourself, you want to show more of yourself, right? So I think apart from the cyclicality or like the phase of nostalgia and all of that, I do think there's something about these a lot of folks, having new looks that they want to show off. And I think that'll play into some consumer behavior. If I'm suddenly, feeling fit, I don't necessarily want to wear an oversized hoodie.
Yeah, so interesting. I think everyone's accepted that attention spans for us all are getting shorter. One of the things that we worry about is that, that's bled into consumers' attention spans for brand, coupled with how many new entrants there are every year, only increasing. Is that something that you think about, of kind of brands coming in and out of product market fit or coming in and out of trend faster than ever? And so as an investor, how do you kind of catch the right 5 to 7 year window?
I think to your point, there is a big overarching theme of timing that really matters regardless of how great something is. Even if you're a successful brand, I think depending on when you sell, you may have had a great outcome regardless, but you may have had multiples of that outcome selling during one period versus another. And so there is definitely a market component. I don't think it's easy to time for those things, especially for us who invest pre-seed. I'm looking at companies that I think will be, you know, large in the next 5 to 10 years. So I'm not a day trader and I don't know how to time the market. I'm optimizing for I have conviction that this founder really understands their consumer and they're building something that is speaking to somebody, and I see a strong outcome. Now, whether that outcome ends up being a $500 million outcome or a $1 billion outcome, I can't tell you. But I have conviction in them that it will be a strong outcome. In terms of kind of what's trendy or a fad, that is something we spend a lot of time on. And I think what we like to look at is what we think is true consumer behavior. So, for example, during COVID, we didn't invest in anything really that relied on the thesis that people were never going to leave their homes again, because we just didn't feel like that was going to be a long-term permanent effect. And so you'd see a lot of companies that did so well during that period of time when people were always home that, plateaued or, even went under afterwards, because that was not a permanent behavior shift. So we definitely do think about, is this a true behavior shift or is this a moment in time?
Even this year alone, tariffs, meta impression, costs being so volatile. How do you coach founders through moments when things are going sideways and capital markets may be choppy for fundraising, margins may be compressed? Yeah, how do you get them to break through that?
I think in the brand category specifically, the bar is different than potentially others. I think, if you compare it to AI, for example, I think there's a lot of forgiveness around profitability or, cash burn that may not necessarily be the case in brands today. And so what we like to coach founders is to preserve optionality. So for example, you may not need to be profitable today, but if there is a winter or a tightening of capital markets, the entire existence of your business is not reliant on the next round of fundraising, that like you have the ability to toggle back and forth. Um, and I think when you talk about tariffs and macro factors like that, honestly, there's always something. So what we like to tell founders is build a buffer. I mean, today it's tariffs. Remember, during COVID, there were huge supply chain issues. And we had some founders who couldn't get, one integral ingredient to make the thing that they wanted to make. And um, so I think there's always something that seems like a unique or once in a lifetime thing, but there's always some iteration of it. And so to the point that I can't predict what will happen, neither can founders. So we always just try to tell them, don't run things so tight that you have no margin for error. And don't wait until the ultimate last moment, again, where you have no margin. Just expect that things will go sideways and just have a buffer for margin for error.
The following message is brought to you by Fulfill, a sponsor of the podcast. Every dollar sitting in slow-moving inventory is a dollar you can't use to scale. Most e-commerce brands have 30 to 40% of their working capital tied up in the wrong SKUs, and they don't even realize it. Fulfill.io changes that. It's an ARP built for Shopify brands that want full visibility into their inventory and cash flow. With Fulfill, you can see days of inventory on hand by SKU, forecast reorders based on actual sell-through, automate purchase orders, and thanks to native 3PL integrations, you'll know exactly what's sitting in your warehouse, not just what Shopify thinks you have. This is real-time inventory intelligence that helps you stop overstocking losers and start compounding cash in the right places. Brands like Grüns, Monos, Mujiri, and Caraway use Fulfill to free up hundreds of thousands in working capital. Don't let your inventory decisions kill your margin. Get clarity, get control at Fulfill.io. Spending money and energy on product innovation versus distribution. Of course, both matter, but if you had to pick one, where would you place the effort?
Probably distribution. I mean, you could have the most innovative product, but if nobody sees it, does it matter?
Yeah. And I think a lot of founders miss that part, right? That they're spending so much time and energy innovating around a novel product, but the go to market is lacking. And then it's just hard to hit escape velocity.
Yeah, absolutely. And like I said earlier, things don't sell themselves. Even when you think of something that seems like a no-brainer, like GLP-1s, right? Somebody has told you about it and it's everywhere and you're hearing, even with that, it's not that the product by itself is attractive to somebody. Somebody needs to educate you on it. Somebody needs to tell you about it. It needs to be available to you. Um, you need to have some kind of awareness on it. So, yeah, I think distribution is really important. I think that's a major shift I've seen when I first started investing. I remember there was an era of D2C brands where folks did not want to sell on Amazon because they were worried about brand dilution. And now people have really shifted their mindset and say, we want to sell where our customers shop. And if you're buying there, then we want to be there.
Is there a tactic, channel, piece of tech that's working especially well for portfolio companies right now?
Well, at the risk of plugging one of our own portfolio companies, we invested in a company called Nectar Social that really focuses on assisted sale, customer service, conversion through DMs. And their philosophy is effectively, you know, a typical customer service help desk or a support ticket is not how somebody who is looking at a beauty brand on Instagram is necessarily, they're not looking at something and wanting the follow up to be thank you for support 104. They want someone to speak to them in their voice, and there's so much engagement happening in those channels that has been historically overlooked. But I plug them to go back into my main answer, which is I think that, there are so many things around so I think the product itself obviously needs to be good or resonate in some kind of way. I truly believe in having an amazing customer service experience, and I think having a great customer service experience is one of the ways that you can get around, um, what we talked about, the trendy fad of switching from one product to another. I know, people historically talk about Chewy, for example, right? Where like you buy something and it doesn't work, and you write and you say, I'm so sorry, like my dog died, and they'll like write you a note or send you a card, or they don't make it a hassle for you. And so I connect that to Nectar in that I feel like brands that are really focused on making sure that it's easy for the consumer to ask questions, guiding them through the experience, don't make it a hassle for them to engage with the brand. I think customer service is really underrated in terms of building loyalty.
What's your biggest piece of advice for founders heading into 2026?
Keep your head up. you know, it's it's such our logo actually is kind of a check mark. It's kind of a wavy thing because it's meant to represent the founder's journey, that it's not just a linear up and to the right path. It'll go up, it'll go down. And being a founder is not an easy experience. You one day you're killing it, and then to your point, tariffs, you suddenly realize this huge margin buffer you had isn't there. And so it's it's completely unpredictable, and I think that it's important to take care of yourself, to take care of your mental health, and make sure you stay mentally strong to go through all of the ups and downs.
Shmeen, as we head towards a wrap, is there anything that you're seeking from listeners, brands that you want to talk to, operators, collaborators?
We always love talking to great founders, building businesses that speak to folks in a different way, or folks that are tapping into super fan communities that are overlooked, or anyone who feels like they have a compelling reason to be the next durable brand. I always want to hear from.
Amazing. Shmeen, thanks so much for coming on and look forward to next time.
Thank you for having me.